Global equities are off to a flying start this week as central banks around the world took steps to support the economy in the face of the coronavirus. The outbreak has stalled supply chains and hit consumer demand. That's prompted the US Federal Reserve to cut its benchmark interest rate by 50 basis points to the range of 1 to 1.25% following an emergency meeting.
The virus and the measures that are being taken to contain it will surely weigh on economic activity, both here and abroad, for some time. We are beginning to see the effects on the tourism and travel industries, and we are hearing concerns from industries that rely on global supply chains. The magnitude and persistence of the overall effects on the economy, however, remain highly uncertain.
Other central banks are also swinging into action. On Monday, the Bank of Japan pumped more than $4.5 billion into the economy. On Tuesday, Australia's central bank slashed borrowing costs to a record low of 0.5%. And the ECB and the Bank of England say they're prepared to provide financial and monetary support to keep their economies stable.
The Bank of England's role is to help UK businesses and households manage through an economic shock that could prove large but will ultimately be temporary. The bank will take all necessary steps to support the UK economy and financial system consistent with its statutory responsibilities. We're monitoring the situation closely across all our functions and ensuring all necessary contingency plans are in place.
These assurances have helped restore confidence among investors. But some analysts say the promise of lower interest rates isn't enough to put industrial output back on track.
You look at the internals of the market, interest rates hitting all-time lows and defensives leading the way up. I think those tell you that it's not necessarily you're not getting the all-clear signal that some people just look at the headlines might see.
They say the slowdown is due to raw materials from China not reaching manufacturers.
It's still tough to gauge what will happen, but it looks like important supply chains are being interrupted. In Europe, the production process is halted. All of German industry is extremely dependent on supply chains from China to complete their products.
Analysts say while cheap credit can help bring more investors to global stock markets, the companies they're pouring money into cannot go back to business as usual until Chinese factories get back up to speed. Mobin Nasir, TRT World.
Well, for more, let's bring in Matt Maley in Newton, Massachusetts. He's Managing Director and Equity Strategist at the trading firm Miller Tabak. Good to have you back with us, Matt. So the biggest interest rate cut by the US Fed since the 2008 financial crisis. Was this the right move in response to this current epidemic?
Well, I think it's kind of hard because we worry that how much of an impact it will really have because this is a supply shock to the system. And usually monetary policy, lower interest rates and stuff helps the demand side of things. So we wonder how much it helps. But at the same time, we've seen this the market was already pricing in the rate cut, and so I think the Fed had to do something to give a little bit more confidence to the marketplace. Now it's kind of interesting. Initially, the stock market in the U.S. rallied significantly. Now it's come back down. It's in negative territory. We'll see how it ends the day, but it would be too bad if they actually inspired less confidence because it was unable to buoy the markets at all. But all in all, I think they had to do something, and the question is, will it be enough to really help this situation?
In his press conference after the decision, US Fed Chair Jerome Powell cited the evolving risks of the coronavirus outbreak as to why they decided to enact this emergency rate cut. What are those evolving risks?
Well, it just has to be the one thing that we I think that people misunderstand. Is that there are still issues in the credit markets that we have to worry about. And now, luckily, the banks are in much better shape than they were a decade ago when we had the credit crisis. But that doesn't mean we can't see stresses in the credit market. And one of the things we saw in this past week in the stock market got hit hard, but we also saw credit spreads widening way out. We saw the junk market get hit, and that's the same thing that happened in late 2018. The Fed really didn't move when the stock market market initially got hit. They waited until they saw stress in the credit markets. So with stress in the credit markets, if they can buoy that, that's going to be very important. Because remember, we just had problems in the repo market here in the U.S. Last fall, just less than 6 months ago. And if things start to creep into the credit markets, it raises the fear level much higher. And I think they're trying to prevent that right now.
So this latest interest rate cut now puts US lending rates between 1 and 1.25%. Donald Trump obviously wants them to go even lower. Do you think the US Fed will heed those calls and slash rates even further?
Well, they might slash them a little bit further, but given we'll have to see what happens with the impact of the coronavirus. Really, the big impact is we start to see more lockdowns like we've seen in China and to a lesser degree in Italy. If those become more widespread, then we're going to have some real concerns about a recession. But the thing, of course, now is that it has to be a two-sided story. The monetary policy can't do everything. The federal government in the U.S. and around the globe are going to have to see fiscal policy. And right now, President Trump doesn't seem to be indicating that he's got any plans to kind of bring that along. So I think the Fed is going to be pushing back and saying, hey, Congress, hey, the president, let's see some more fiscal policy because we need a coordinated effort.
So are you worried, Matt, that this worsening outbreak may lead to a recession in the US?
Well, the odds are certainly growing as the situation progresses. And, it's the one thing that of course is a concern is that recession, bear market. The last two ones we've had have been so deep and so the stock market went down more than 50% in both cases. The thing is, history tells us that most bear markets and most recessions are nowhere near as deep, nowhere near as serious, and actually are normal and healthy, as scary as they are and as painful as they are. So, to answer your question, yes, the odds are certainly rising. It's not my base case. I don't think the odds are over 50%. But again, I think the key is going to be this: if these lockdowns we've seen in other parts of the world start to spread to the U.S. into more of Europe, then the odds will grow even more.
Okay, you mentioned that perhaps governments need to enact other measures apart from monetary policy in terms of addressing this outbreak. What are those other measures, do you think?
Well, I think number one has got to be in the infrastructure areas. At least in the United States, we've heard about and we've witnessed the crumbling of our infrastructure for many years now, and so there's something that needs to be done anyway. You don't need one of the biggest infrastructure programs we ever had was during the Great Depression. We don't need a Great Depression to bring those on. These are things that are needed. And things will create more jobs. And if we have a recession, people will certainly be losing their jobs in the private sector. So why not have something in the public sector that can create further ones? And the need is there. So I think, and also they're a little bit easier to pay for with toll roads and things like that. But I think that's kind of the number one issue where it's not only needed, but politically people will buy into it.
Okay, Matt Maley in Newton, Massachusetts. Thank you as always for your analysis.